Hello everybody, Jackson from the Wealth Squad here. Today we'll be talking about how to invest in a market crash. So obviously we're going to be basing all of this off of last year's crash in which every single stock fell, some more than others, and we're going to be going over what stocks have done best since then, right? So there is, of course, preference, right? So if you're not looking to invest too risky, then don't. If you want to maximize your money, then you're going to have to include some risk. But let's go over some trades that you could have taken back in March 2020 and use this knowledge for the next potential crash, right? How to invest for the next crash. So right away, you can see Overstock.com. Overstock.com is a furniture retailer that's only online. And you can see that in March 2020, the stock got decimated, right? We can see the year. We'll zoom out a little bit. And we could see bottom of March 2020 is trading at $2, okay? Right now it's at $70. So, you just 35 times your money. Every dollar you had invested in Overstock is now 35 times more. This doesn't always happen, right? This is an extreme example. But you could see just the power of, this is a risky company, right? Back in 2017, it was a crypto company, right? It had everything to do with crypto. And since then, it was failing. It was not looking like a good investment. Normally, you should not even touch this thing. But in a risky environment, such as a crash, go for the risky stuff because that's going to return the most. We're going to show some other examples, right? So Overstock's a big one. Wayfair, same thing. Also a furniture retailer. And you can see it's at 26 bucks. Now it's at 290, times 11. Then we have Gap. So this is not as risky, right? Gap's been around for a while, but it's not a good business in terms of sales are falling, profits falling, everything's moving online. Gap's trying to basically stay in, person to person. So if you're looking at this without the COVID crash, I would not even buy it, right? Because the only thing it's got going for right now is like the collaboration with Yeezy. But besides that, it's a failing clothing retailer, right? So, but in March 2020, it's at $5. Now it's at 28. That's just because the risky companies do best after the crash. And I'll show more examples like Gap, of course, Macy's, same thing. Not as much, 4 to 22, but you can just see the absolute destruction of this stock over the past years, or just since 2015, nothing but go down. And of course, it finally reached its short-term bottom, or maybe long-term bottom, who knows, at $4 last March, and it's now 22. Then we have some extreme examples. Not necessarily extreme, more like super risky. We have the cruise lines. NCLH, Norwegian Cruise Lines, where this stock was at 60. A week later is at 7. That type of drop does not happen normally. Of course, in terms of COVID, it happened to a lot of stocks that are in the business of person to person. So 85% drop. When COVID bottomed, or of course the COVID crash, it was at $7. Now it's at 24. And when you buy a stock that discounted, 85% off, and it doesn't go bankrupt, you're gonna make money. That's the only risk, right? Is if it keeps falling. But a company like a big size, it does not accept the loss. It fights, right? It wants to stay a company. It doesn't want to be some remembered company back then that failed. And then cruise lines, Carnival Cruise Lines, not as well, right? 7 to 20, but still destruction of the stock from 40 to 7, still apparent. Then we have some airlines, of course. Delta Airlines went from 60 to 20, so not as big of a drop, but now it's at 40, right? Still doubled from here. That's actually not too good of a trade, right? Because the normal market doubled from there. American Airlines, right? It was at $8. Now it's at 19. Better than a double. And then we have like the cruise lines, the airlines, and then like the amusement parks. Those are all businesses that were just destroyed because their main business was wiped off. It was wiped away. It doesn't look like it was going to come back, and of course it did. But Boeing, big example, because it was the hot stock for multiple years. Then it went from 340 to 80. Now it's at 220, right? So that's definitely a good trade if you could buy a stock that is government backed, right? Because that's what Boeing does, is makes airplanes, and the government buys airplanes. 70% off, you're gonna make money, right? If the company doesn't fail, that's your only risk. But here's what I think about that, right? Your risk ratio is like, let's say 1 to 3. If you buy the stock and it fails, that's the 1, right? That's the potential loss. But 3, 80, 160, 240. And it did hit 240. So it's a 1 to 3 risk, for Boeing at least, or it was. Six Flags, same thing. Their business was wiped off the planet, right? Their main revenue source was gone. $11, now it's at 40. And then Dave & Buster's, also trading at a penny stock. It was at $4, now it's at 33. So what I'm trying to show you is the risky companies in times of uncertainty do the best after, okay? Not many companies completely failed, if, more than a handful. Most, if not all, bounced back. But then we have like Home Depot. That's not a risky company, but it's still doubled, right? Because it's a growth company, right? Its earnings were affected so heavily, or apparently affected so heavily, and it bounced back just as hard. Apple, also growth company, tripled from COVID times. Then we have Nike, was $60. Now it's at 160. Google, like when I'm listing off, these aren't risky companies. They're simply high valuation business technology companies, right? $1,000, now it's at approaching 3,000. These companies even doubled and tripled from the bottom in March. Facebook tripled, 140 to 360 almost. Almost tripled. And then what I'm trying to tell you is to avoid like the safe stocks. In times of uncertainty, you're going to want to fled to those, right? Because these stocks aren't going away. Like, it's almost guaranteed they're not going away. But they also return the least because not as much uncertainty was in the beginning, so stock didn't drop as much. Procter & Gamble, lowest was 90, now it's at 140. Coca-Cola hasn't fully recovered. But still, 38 to 56, not that good compared to everything else. Walmart, I guess, yeah, around here, 107 to 150. So Walmart, Coca-Cola, and Procter & Gamble all fell behind the market. The market has doubled since the March 2020 low. The risky companies, the airlines, the cruise lines, failing clothing retailers, failing furniture retailers, all have more than tripled. But the high tech stocks, the high growth stocks, more than doubled and tripled. So next time there's a crash, don't go towards the safe dividend paying stocks. What you want to do is risk your money, because that is when you make the money. Penn National Gaming was failing, right? It was at 38, went all the way down to $4. From now, it is at 70. Now, that's just not because of the crash, right? The business has actually done well since then. But still, 4 to 70. Your 100 share investment right here would be worth $7,000. $400 to $7,000. Meanwhile, in Walmart, you'd have 400 to 600. So go towards the risky stocks. That's when the money is made, but that's where you're going to have to take a risk, right? So I hope you learned something from this video. You know, next time there's a crash, maybe don't look towards the almighty safe dividend stocks. Maybe go more risky, right? Because you're going to make a lot more money that way when they recover. Your only chance of failing is if the company completely fails, right? And that's your 1 to 3. 1, it fails. 3, it triples, right? So that's the video. Thank you for watching, and I'll see you later.